Good afternoon, everyone. I think we have all the speakers here. Um, I think so. I want to just welcome everyone to our FOMC space. For those unaware, I'm sure you are aware, we had another bank failure. We are at what many may call the precipice of the Fed's decision. One more hike and a pause, or pause and see effects. So with that, I kind of want to welcome everyone for starting their afternoon with us. I'm Unusual Whales, and I'm happy to have Nicholas help lead the conversation. Nicholas, if you can.
How's it going, everybody? Excited as always to have all these great macro speakers here with us today. A lot of repeat faces you're used to seeing on these panels. Super excited for that. Now, all panelists, as you know, and those who frequent our spaces know, I really like to keep these spaces open for discussion. I like to have a lot of discourse. I like to get a lot of points of view on every topic we cover. So please, if you want to add to anything somebody said, or maybe even disagree, please just throw up that hand raise emoji on the spaces and we'll get right to you next after that. I would love to get a lot of discourse. We have a lot of things to cover today. So what we're going to do here at the top of the show is just go through our panelists, give a little introduction, let you guys plug anything you want that you're working on or that you have put out or have coming out. We're happy to pin that to the top of the space here. So let's get started here. First off, Joseph Wang, the incumbent Fed guy of Twitter. Want to welcome you back, Joseph. Our go-to Fed guy, headed the trading at the Fed's open desk, has a great introductory book on central banking called Central Banking 101, is the CIO at Monetary Macro, and just launched a bunch of macro courses. Hey, Joseph, how you doing today?
Hey, Nick. It's great to be here. Thanks so much for inviting me. Thanks so much to be on the panel with such great guests. And I also want to note for the audience to congratulate Unusual Whales because, as was reported today, Congress is introducing a bill to ban trading by Congress members. And a lot of this was because of reporting that Unusual Whales spearheaded. So I think that's a really, really good thing that's happening right now. So appearances of insider trading are not really good for our country. So thanks so much for your efforts.
Hey, we appreciate those kind words as always, Joseph. Thank you so much. It's really nice to see, the headway that Unusual Whales is making. Next, we've got Jem Carson. Jem is a leading volatility expert and an expert on croissants and jam. He can explain the ins and outs of Charm and Vanna and how to use options in a changing market and how those options change the market. He's a founder of Kai Volatility, which you should all be subscribed to immediately. And check out his speaking on YouTube and Spotify. Lots of appearances from him on various podcasts and news outlets. Jem, thank you for joining us.
Thanks for having me. Always a pleasure. I always learn as much as kind of educate on here. We're at an interesting crossroads. Excited to talk about it.
Excited to have you, man. Thank you. Next, we've got the last bear standing. Another friend of the spaces. Last Bear is an expert on markets where he writes about monetary policy in his weekly Substack. If you're not subscribed to that Substack, go do that now since he cannot share it on Twitter with the link issue we've got now. Welcome back, Last Bear. How you doing, man?
Hey, thanks, guys. Yeah, click through the tiny URL links, which is an unfortunate reality that we live with today. But yeah, thanks for having me, guys. Is really excited for an exciting FOMC meeting here, and speaking with the great panelists that we have today. So looking forward to it.
As am I. Thank you, Last Bear. Next, we've got Bob Elliott, the CIO at Unlimited Fund, former IC at Bridgewater, and the all-time leader in useful Twitter threads during a banking crisis. He's a friend of these spaces, so let's give him a warm welcome. Welcome back, Bob.
Hey, Nick. Thanks so much for having me. An exciting time. This banking crisis never ceases to keep things interesting, certainly. So that and the macro, we've got a lot to talk about.
Thanks for coming as always, Bob. And we've got one more panelist, a late joiner here. Thanks for coming in at last second. Michael Cow, the Chief Investment Officer and Portfolio Manager of Cow Family Office. Having worked previously at Acanthos Capital Management, he's an expert in commodities, index arbitrage, and dynamic hedging. and looking exceptionally cool during interviews. Michael, welcome back.
Yeah, thank you for taking me last minute. I have to admit, I'm probably going to do more listening than speaking today, as I'm just getting back from a 2 weeks of intensive travel. So, but yeah, there's a lot to talk about though. So, thank you.
Hey, happy to have you, exhausted or otherwise, Michael. And again, of course, if anything you want to add, feel free to raise your hand. Happy to get you. So I think we can jump right into things here. So as always, before we get started, let's take a quick look at where things stand since our last panel. At the last FOMC meeting, rates were raised 25 bips again, marking 9 straight increases to borrowing costs. The U.S. GDP growth slowed to an annualized adjusted rate of 1.1%, far below the expectations of 2%, showing slowed momentum. Core PCE remains elevated, largely in part due to labor costs. And as you all know, 4 large regional banks have failed since March, which we will be deep diving shortly. And the debt ceiling standoff persists. So let's start right off here with you, Jem. Where in the heck are we in the rate hike cycle? We'll let you start, and then we're going to do the whole panel.
Look, there is a dramatic lag. A lot of people talk about it to monetary policy. Some say 18 months. I think somewhere between a year and 2 years is appropriate. A lot of, and I've mentioned this before, there's about $450 trillion of long assets. Only 100 trillion of those are equities. The other 350 trillion operate at a dramatic lag. Not to mention even equity demand with buybacks operates at a dramatic lag. So the Fed knows this. It is trying to get a pulse on what's happening out 6 months from now, right? Housing starts was multifamily was up 22% last month. That's not because of what's happening now. That's not because of what happened a year ago, right? And so the question is, now that we're 5% into this, what's happening? And that's a tough thing to gauge based on kind of short-term data. I think there's some confusion and debate going on at the Fed right now. There's multiple, differentiating opinions as we work through that lag. And my guess is the solution will ultimately end up on let's wait and see, right? That doesn't mean they're not going to do a quarter today. They'll do a quarter today, but I do think that the party line is likely to be, we're doing a quarter. Let's wait and see what this does. And I think that is at baseline dovish and will be seen as dovish by the market, despite their now need to kind of talk, back up yields in the back of the curve. So I really think, they're going to want to pause. They're going to want to take a look, but they're going to really be heavy-handed in trying to tell the market we are not going to cut. Now, we'll see about that, but that's the messaging coming forward, I believe.
Thank you, Jem. Does anybody have anything to add to what Jem said? Maybe any echoing of his sentiment?
So I agree with what Jim mentioned. I think if you look at market pricing, the market pricing over the past few months has always been very eager to price in rate cuts in. So when if the Fed were to suggest some pause in looking at the data, immediately the market is going to take that and run with it. Now, just to level set a little bit, as you mentioned, Nick, inflation, according to the Fed's favorite measure, core PCE, is still really high. It's over 4%. Now, when you think about the channels through which monetary policy is supposed to act, it doesn't seem like it's working as well as I think would be expected. For example, first off, monetary policy can affect aggregate demand by lowering asset prices, reduce wealth, reduce money to spend, reduce demand. But here we are, S&P pretty elevated. Risk assets basically largely recovered. The tumble we had last year, still not at all-time highs, of course. Or if you look at interest rate sensitive sectors of the economy, like housing, house prices seem to be stabilizing and rising in some areas. If you look at home builders, they're all at all-time highs. So you would expect there to be a substantial slowdown there, but I think because of low inventory, that's not super happening. And again, another channel is dollar strength. The dollar has been weakening a lot these past few months, and that's all conventionally how we think of monetary policy as acting. And at the same time, we're at 5%. So it doesn't seem to be working as well as the Fed thought. And again, looking at fundamental data like wages, most recently employment cost index accelerating last quarter. So the Fed is in a tough place right now because its tools don't seem to be working as well as expected, I think.
And we'll definitely touch on all of that again as well. Bob, I saw you unmuted. Get your input here, and then we'll kick it over to Michael.
Yeah, I mean, I think this is, I think those of us who follow the markets and the economy on a day-to-day basis can easily lose sight of sort of the basic picture of where we are, and I think Fed guy covered it well. But at the gist of it, like nominal growth in the first quarter was 7.5%. The productive capacity of the economy is 1.5%, give or take. What that means is either real production conditions are tightening, which overall the economy has to either tighten or inflation has to make the gap between that nominal growth and the productive capacity of the economy. And that gap is leading to an unemployment rate which is at secular lows and is leading to an inflation rate which is well above the Fed's target and not showing enough signs. There are maybe a few signs, but not enough signs of moving down towards target anytime soon. And so when you put that together, it looks like there's still a lot of work to be done. And I think the main question from the Fed's perspective is how much do they bet on the long and variable lags to resolve the circumstance, or at the cost of the risk that inflation becomes increasingly entrenched in the economy, which is what we're seeing. And so that's really the trade-off: is how much are they going to bet on being proactive to ensure that entrenchment doesn't persist, versus betting on the lags. And the Fed is not particularly good at their predictive ability, and so I think they're probably going to skew towards what they see and responding to what they see relative to.
Michael, go ahead, see your hand, and then Jem, I'll get your input there as well, and we'll keep plugging along here.
Three brief themes I just wanted to touch on and maybe build a little bit on Joseph's comments on how the Fed's tools are not working so well. I've been in this higher for longer camp for quite a while, and I too agree that risk assets at least don't seem to buy that. Seem to be pricing in quite a fast pivot, which I don't agree with for a number of reasons. But I want to point out the last Substack post that I wrote about 2 weeks ago before I went on vacation was talking about this geopolitical aspect of the surprise OPEC cut, and how I thought that in an effort to sort of skirt short-term pain in the oil market, it would actually potentially backfire on OPEC longer term in making the oil market more elastic. But as I've been chewing on this, I actually think that perhaps this is exactly what OPEC wants, because OPEC does not want a flyaway oil market. For years I've been thinking that at some point this decade we're going to have a supply-demand singularity point where OPEC loses control of the market due to years of decreased investment in the sector. But I think that's really been pushed out because I think spare capacity is significantly higher. But I want to go back to this, my comment with respect to how it affects Fed policy. I really think that MBS's visceral hatred for this administration is coloring OPEC policy disproportionately, because the last CPI print, did not. Actually, I'm not sure. I think maybe this April CPI did take into account the impact of the Fed cut. Regardless, oil prices have spiked up and then right back down. But I think because of the lag in the data, it's going to keep Jerome Powell on his toes with respect to commodity price inflation, for one. Number two is I had this wild thought this morning that listening to a podcast about how, in a way, there are interesting ways how rate hikes may actually be spurring the economy in certain ways. And sometime last year, I tweeted out about how isn't it ironic that the same baby boomer Fed heads that got us into this mess are now creating a situation that is directly benefiting the richest demographic of all, that is the baby boomers, that tend to have higher proportions of their net worth in fixed income, which for years have not been earning anything, right? And now all of a sudden you can earn 5% risk-free, debt ceiling notwithstanding. So I think that's another thing to talk about and think about.
Thank you, Michael. Go ahead, Jem, and then we'll move on to the next question.
Yeah, I mean, I started this out by talking about what the Fed is likely to do. That doesn't mean what they're likely to do is going to work. I think they're stopping and looking at the economy and saying, what is cyclically happening? Are we having this success in slowing down this economy? Because that's how they've worked for the last 40 years. And that cyclical kind of Fed effect has been all that has mattered. But the reality is, as I've mentioned in other conversations, this is not about, the inflation here is not about cyclical strength or weakness anymore. That is a blunt instrument that is not solving the problem. And as we've seen, labor strength and broadly sticky inflation has been incredibly sticky and will continue to be regardless of the cyclical weakness that we see. What happened during the 70s was not, it wasn't GDP weakness. Yes, we had 3 recessions, but GDP grew above trend. It was margin compression that was driven by a lot of things, including higher interest rates, ironically. And that kind of, we see that strength being pushed through fiscal policy, whether it's the employee retention credit or any of the other things that we're continuing to see coming from the fiscal side, supporting labor and broadly people on the bottom of the distribution. Onshoring, deglobalization, all those things are huge forces that are continuing to underpin that labor strength and domestic production that is totally going against trend to, in a secular way, against this, cyclical economic weakness strength argument. So everybody's looking at cyclical. Are we going down? Are we going into a recession? And that's what the Fed's looking at too. Unfortunately, that's not what matters. And ironically, by increasing interest rates, we're making these secular issues that are driving structural inflation worse. Those two counter effects are likely to lead to stagflation. There's that word. And it's what nobody's talking about, but it's the worst case outcome. It's a case where we get a recession, a minor one. It's still demand push, though. Domestically, labor, is still relatively strong. And yes, inflation comes down a bit, but stays well above that 2% Fed target and continues to force the Fed back into what is an already weak economy. So I think that's the big picture as we look forward. Right now, everybody's focused on the recession. Is it a recession? Is it not? But, the real story here happens when people begin to wake up to the fact that this is not a cyclical story.
Thank you, Jem. And you actually touched on a lot of things that I'm going to want to dive into here in a bit. But first, let's touch a little bit more on the rate hike here. So according to their March projections, Fed officials seem to believe that interest rates will peak in a target range of 5 to 5.25% before pausing. FedWatch has a 25 bips hike at 86% right now, with the current rate at 4.75 to 5%. This has many speculating that today's rate hike may be the final hike, followed by a pause. So Last Bear, what are you seeing in the current market? Is this the last rate hike? And do you expect to see another 25 bips hike as many project? And also, do you have any other comments on what the panel has just spoken about as well, Last Bear?
Yeah, sure. I think that it's likely that 25 basis points happens today, if just for the reason that it's what's widely expected and sort of priced into the market, and the Fed will just take that if it's given to them without trying to make a surprise and caught, throwing the script off, so to speak. But I do think that this is probably the last pause, at least of this immediate term of the cycle. It's possible that after a period of a pause, depending on where inflation goes, they might have to consider raising rates. But I think the number one thing on the Fed's perspective right now is financial stability over inflation at this point. If you consider what's going on in the banking sector, I know that there's a ton of opinions about how important or not important that is. But at the end of the day, if rates were at zero, then none of these banks would have failed. And even if the long end of the curve was even at the levels of the short end of the curve, it's obviously historically inverted right now. But if you had long rates at 5%, it would make these banking issues significantly worse, and would put more banks insolvent on a mark-to-market basis if you look at the value of their assets. And I think that the Fed is absolutely concerned about that and thinking about that as they make their monetary policy. I think they've been pretty clear about having, getting to 5% as kind of being the tip of this wave. And I think that they'll probably stick with that, especially given that while inflation is higher than they would like it to be, there has been signs of deceleration across a number of different categories, including some of the more lagging categories like rent and shelter inflation. And if you look at loans and leases and bank credit, it was increasing at a very high rate in 2022, one that would have been inflationary and probably added to the inflation pressures of 2022 had it continued. But really, since the past 6 months or so, you have seen a significant deceleration in the rate of loan growth at banks, which I think the Fed is happy to see, but now verging on the point of outright contraction in bank credit. I think that they're at the point where they can recognize the lagging effects that we've talked about and are ready to at least take some time and see what happens over the coming months.
Thank you, Last Bear. Does anybody have any comments before we move on to the next question here? You gave me a pretty good tie-in to a topic on banking.
I do have a comment.
Yeah, please.
Maybe I would push back a little bit on the notion of long rates potentially being that bad, because last year, Joseph and I, you remember, we talked about the idea of a potential bear steepener as an out-of-the-box strategy that the Fed might pursue in conjunction with the Treasury. Obviously, the Fed can't influence long rates directly, but I wrote a thread talking about how if they engineered a steep yield curve with long rates higher, it would obviate the need for them to use the very blunt tool of just Fed funds. And my concern at the time in writing that thread was exactly what we're experiencing right now, which is when you've got an inverted yield curve and you've got Fed funds so high, there's a huge amount of floating rate debt out there. And by the way, that shoe has not dropped yet. The leveraged loan market, I think, is going to be a problem because the borrowers at LIBOR or SOFR plus 500 at the beginning of the year just saw their interest expense shoot up from 5% to essentially 10+%, right? And that's a big chunk of the overall corporate debt market. The other thing is that with respect to banks, yes, even though with higher long rates, it causes mark-to-market losses on long-lived assets. It allows the Fed, I would argue, to stay at a lower front-end curve. And so by having a normally shaped yield curve, you still have positive NIM. Here we have the worst of both scenarios, right? Where you've got a steeply inverted yield curve, and banks have suffered losses on their assets. The shoe hasn't fallen on floating rate exposures, and the banks have essentially negative NIM, so they have no ability to earn their way out. So that was my concern with this this approach in the first place. But I recognize there's no easy solution here.
Thank you, Michael. Lesbear, do you have any response to that before we move on?
I would only add that I think that if the Fed wanted to, one thing that I've written about recently is just the dot plot, which at the last meeting in March when they put out the most recent dot plot, still showing the long run estimate at 2.5%, and it's actually interesting over the course of the history of the dot plot, which is about 10 years old at this point, that has gone from 4% when it first came out in 2012, and has sort of gradually fallen down to 2.5%, where they hold it today. Despite obviously having a higher federal funds rate than at any point in that prior period. So the Fed is kind of guiding via the dot plot to an inverted yield curve. And I think part of that is because they don't want to see, is because they want the long end to stay in check and not put additional pressure on these sort of longer duration asset values, bond prices, that sort of thing, and a hope that they can sort of stamp out inflation in the front end. But that was the only other point that I would add.
Thank you, Last Bear. So I'll jump right along here and let's get a little bit into some of the banking and treasury problems. So for those who don't know, Janet Yellen and the U.S. Treasury said that they will launch the first buyback program since 2000. Bob, you recently said in a tweet that, quote, the regional bank crisis at this point is not primarily a credit problem, it's a policy problem. Bring back TLGP and it's resolved. Bob, can you break that down for us?
Yeah, I mean, I think there are, as Michael highlighted, there's there's cyclical dynamics that are negatives for the regional banks related to a slowing of the provision of credit and credit losses that the regional banks will likely take on their existing stock of loans, and rising deposit rates that will likely compress NIMs to some extent as well. But that set of circumstances is eminently manageable, as it has been through previous cycles where banks have faced similar conditions. That doesn't mean that no banks will fail. It doesn't mean that bank earnings won't be weak or poor. But given the fact that we have some of the best capitalized banks that we've ever had in 50 years, and if we were just facing that set of circumstances, this would be like a crummy time to be running one of those banks, but not a systemic risk. I think the issue that we face today is the fact that there is not a regulatory framework in place that is sufficiently modernized to handle the banking needs of particularly those depositors who have transaction needs, but are above the $250,000 cap. Those small businesses, let's say, I'm not talking about Apple or something. I'm talking about people with 50 employees who are paying payroll every 2 weeks. Those businesses traditionally aren't banked by the big banks, are banked by the regionals and the small banks, and often can have and are not making bets on interest rates. They're not using their deposits for savings vehicles or anything like that. Those are the types of businesses that face a particularly acute dynamic right now, which is when they see the stocks of whatever regional bank or small bank that they're putting their money into starting to go down, their immediate move is to pull out their money and try to move it to anywhere they can that isn't under a speculative attack. And that's creating bank runs, not because of some meaningful fundamental reassessment of a given bank's creditworthiness. It's a bank run that's a function of speculation, and that is not a good thing for anybody, because that's both creating risk to the banking system, but also destroying aggregate franchise value and creating more meaningful risk of the FDIC needing to take over banks and resolve them, which is a net negative for the taxpayer. And so what we have right now is we have a bad policy. We have a fine, not great, but fine regional and small bank system that could totally withstand this what it faces them on a forward-looking basis, but a policy-driven set of bank runs. And that's what has to get resolved, is the current regulatory framework is not resolving the policy-driven bank runs that are forcing small businesses that are the big uninsured folks who can move quickly to pull their money out of, banks that are in the headlines. And that's why I say, bring TLGP back, and this will be resolved, because as long as those small businesses know that their transactional deposits are going to be safe, then there is no reason to quickly move your money from one bank into the other. And that really is the problem that exists right now.
Thank you, Bob. Does anyone have anything to add?
Yeah, I'll add to that using Pacific West as an example. So yesterday, Pacific West price declined by about 30%. That's a pretty big decline. But if you look at their earnings presentations, they'll actually show you that over the past month, their deposits have actually stabilized and slightly increased. So in their presentation, they'll tell you that they had a lot of deposits, specifically VC deposits, leave in March. And then afterwards, the panic faded and deposits began to come back. So it was a sign that it was stabilizing, and many other regional banks noted the same thing. But suddenly, yesterday, their stock price declined by 30%. There's some good reporting by Eric Wallerstein of Wall Street Journal suggesting that, suddenly there was 200,000 put options put on it. So it could be some sort of speculative attack. And as we know, sometimes price shapes narrative, and someone who banks with that bank could easily see the stock price and panic, and an otherwise fine bank could be ruined, as Bob was noting. It does seem that the administration is aware of things like that, and the Fed and the Treasury have basically de facto guaranteed deposits. So I think it's hard to know if there's actually an underlying run happening. All we saw was the price. We don't actually know if there are actually deposit flows. I mean, if you are a business, seeing that everything else was guaranteed by the administration and the Fed, it would seem like you would be less inclined to panic. But I agree that we really need something a bit more stronger, like Bob suggested, to put this completely to rest.
Thank you, Joseph. So, Jem, you just yesterday appeared on Power Lunch and briefly touched on regional bank nervousness. Now, based on Joseph's comments on put option and panic, you said, quote, "The reality is it's a self-fulfilling prophecy. If there's a run, there's a run. It can keep going. It's a function of time. It can get ugly." Then went on to comment on the Fed's role. Jem, how do you feel? Is there more banking turmoil to come?
The reality is it's not about is there or is there not, right? It is a fat tail, the more there's a distinct kind of fear of it, the more, especially in this world where, with digitization, people can move money very quickly. There's 100% a significant risk there. Now, the question really is, can the Fed continue to get in front of this? What are their limitations? Can they backstop all regional banks? Where is FDIC, in all this, and what political measures have to be, agreed upon to go that route. So they're walking kind of this line. They don't want to go out and do all of this now. Which means if it happens, they'll have to be pushed into the fray. But the reality is there's always a tail on banks. Banks, by definition, are have massive leverage underneath the hood. And if things get bad, it gets worse, right? It has a negative momentum factor in there. So to answer your question, yes, it's entirely possible. Markets have a way of forcing the Fed's hand, government officials' hands. That said, it doesn't mean it's going to happen today, tomorrow. This is kind of a rolling issue. I do think before this is all said and done, we will see a lot more kind of blood in that world. But again, we could be significantly higher. It could be months from now. But unless they come out and proactively deal with it, eventually it is always a kind of gap to be filled in a kind of trader terminology.
Can I chip in on one big picture issue here and
Please,
perhaps pose the question to the panel? I mean, and please don't shoot the messenger here when I say this, but isn't all of this basically part of what the Fed is trying to engineer? Because in order to really put the kibosh on inflation, they need to lower aggregate demand. To lower aggregate demand, you ultimately need to engineer a significant amount of job losses from the current record low unemployment rate. And so, given the fact that we don't have a systemic banking crisis like 2008, and certainly we have a problem in the regional banks, and it's not a great result that it's obviously forcing consolidation into the money centers. But at the end of the day, I keep hearing all of these podcasts with people expressing shock that this is going to cause credit contraction. And my response when I hear that is, that's what the Fed wants.
Yeah, I mean, I don't disagree with that. We can argue whether or not whether the cyclical reduction in demand that they're trying to shoot for is ultimately going to solve the bigger problem. But yes, I agree with you that particularly taking the air out of tech and growth and leading to more job losses there and credit contraction would be a goal. The question is again about distribution. What they don't want is a liquidation. They don't want a vol event amidst all of that, I would argue. And so, is this the way that you're going to do it? There's other ways to probably get better, more linear effects to credit contraction.
Bob, I see your hand there. Would love to hear your comments here, and then I'm going to move on to a question for last.
Yeah, I think the idea, does the Fed want to create a slowing of credit as an instrument to cool the overall economy, given, frankly, the big picture narrative is at the big picture macro level, they actually haven't made that much progress on asset prices, unemployment, or nominal growth or inflation. Absolutely. The question is, do you do that in an orderly way or a disorderly way? And doing it in a disorderly way has a lot of second and third order consequences which are undesirable and does create the risk, is any one of these little banks like PacWest or Western Alliance or whatever, none of them are systemically important in and of themselves, though the question is, if not managed effectively in the way that I described, you do actually have a risk of a big set of moves out of the regional and small banks. And if you talk to entrepreneurs running businesses with 10 to 50 people, it's amazing how many of them are sitting there trying to figure out how to get banked by systemically important banking institutions in one form or another, and figuring out ways to transfer money into those banks. And if that became small banks in general are like a third of the overall credit system, and so you could have a meaningful risk that's bigger than any specific bank if they let this continue to spiral along, which is why it's a challenging thing. They need to tighten monetary policy, or they need to keep monetary policy tight to deal with the macro circumstances, and they need to make sure that there isn't a systemic bank run. And in some ways, those two things cut against each other. But really what it is that there's different appropriate policy that is the best policy given the circumstances to ensure financial stability and also to resolve the macroeconomic dynamics that are out there. And that's, that's a bit nuanced. but that's, the reality of the challenge that the Fed faces, given the fact that they have all three of those issues: employment, inflation, and financial stability to manage at any given point.
Thank you, Bob. So moving on here, I do want to keep touching on this topic of banks. Now, Last Bear, in your recent piece, The Last of First Republic, brilliant title, by the way, you dove into the details of FRC's situation just days prior to their failure. This week, you posted a tweet regarding the bank crisis fears, citing key differences between this current situation and 2008, and that one cannot be a doomer and they cannot be an all-clear evangelist. Now, Last Bear, can you touch on those and on what you meant by we need to pay attention to the interplay between rates and bank capital?
Yeah, so I think it's like that was probably more a reaction just to, I think, how online discourse tends to go, where things are one extreme or the other, and oftentimes they're the reality somewhere in the middle, and it requires a little bit more nuance in that. So this time is not 2008, it's 2023, and so it's going to be different in a number of ways. So the large systemic banks are in a much better capital position, obviously have the ability to, as we've seen with JP Morgan, to actually potentially advantage from the situation. But at the same time, you do have a large amount of concern across banks that don't have those same stringent capital requirements and who've seen their liquidity and deposits start to roll over in the past year in a way that is very atypical for banks. If you look in aggregate for deposits to be falling the way that they are, at the same time that these banks are dealing with rapid change to the interest rate policy, where, like, in the case of First Republic, they were able to manage 57% deposit withdrawals via borrowing through the Fed's facilities and federal home loan banks and whatnot. They met that request, but basically destroyed their balance sheet in the process because of how expensive that new financing was. And in order to get rid of the financing, they would need to sell their assets, which happen to be underwater, as are most fixed rate bank assets at this point, given where the rate hikes are. And I think that we're at the point where you can't argue that monetary policy and financial stability aren't in some way in conflict. And I think they're directly in conflict. The reason why bank assets are being impaired is because of interest rates, not credit losses. And the reason why deposits are falling is because of QT. And so it's just, we're at a point where I think Bob mentioned it earlier, and I agree with this, where this is very much a policy-driven situation that we find ourselves in my perspective. And therefore, I think it's going to weigh heavily on the Fed's decision. And I think it should weigh heavily on the Fed's decision because they really are in the driver's seat in a lot of these dynamics. So it's definitely not the same as the last time. It's not, if you're saying that there's issues in the banking system that haven't been resolved and are likely to continue to play out, that doesn't mean that you're saying that the stock market's going to crash and that we're going to have some giant great recession. It's just noting what is a serious issue in an important industry and part of the economy, and something that the Fed is particularly going to pay really close attention to. So I think that was the thrust of what I was trying to say.
Thank you, Last Bear. Does anyone have any comments to Last Bear's response?
I think I'll make a note about the asset declines in asset value on banks. I think that's a really good point, and it's been made widely that when the Fed hikes rates, yes, if you have a lot of fixed income securities or fixed income loans, your asset side decreases in market value. But I'd also think that we should have to look at the liability, because rising rates has an impact on those as well. And now we commonly think of a bank as having, let's say, a lot of demand deposits funding its assets. Now, in theory, of course, everyone can go and take their money out of the bank anytime they want. It's like an overnight loan. But in practice, it really isn't. Now, if you think about something from your own perspective, let's say you have $5,000 in the bank. Every month you get inflows from your direct deposit and you spend money. So 5,000 plus or minus 1,000, 2,000, something like that. But there's always some certain amount that you keep in that bank. In a sense, let's say that's 3,000. You always have a minimum amount of 3,000 in your bank account. In that sense, you're basically lending to the bank permanently $3,000, or from the bank's perspective, it has a $3,000 liability that it never has to repay. So you can easily think about that as a longer dated debt. So when you hike rates, yes, your assets decline in value, but to the extent that you have these sticky deposits, these sticky core deposits, they also decline in their market value. And so again, it doesn't necessarily make you insolvent or hurt your solvency position. Another way to think about this is that these deposits, core, sticky, you don't really have to pay them very high rates. So as interest rates rise, your net interest margin on these assets increases. However, of course, as we all know, sometimes deposits that are thought to be sticky suddenly disappear and they're not sticky. And when you do that, everything that was modeled as longer dated becomes overnight. And if you have mark-to-market losses, your bank can go under. So a big part of a well-run bank is to make sure that your liabilities, your deposit franchise is managed so that you don't have these sudden events. And as we saw, the banks that had these big events, they were not very good at this. In fact, they kind of took in a lot of hot money related to things like speculative tech and so forth. So I'm a bit more positive about the regional banks in general. One way that I like to go about thinking about this is to actually hear what they say and see what's on their earnings. And widely speaking, these regional banks are reporting pretty stable deposits. Now, this could all change if we have a speculative attack that shapes sentiment. But as of their earnings release a couple of weeks ago, I'm more constructive on all this than I think most people are.
I just want to add, I think that's a great point that Joseph made around deposits, but I think that's why QT is really important here, and it's not discussed nearly as much as it should be as an important monetary policy position, because with QT lowering, it's basically forcing, deposits stay there forever so long as something doesn't force them out, and so it's reasonable to think of them as super long term. But QT is forcing them out, and so that's forcing a crystallization of asset losses on the other side. So I think that that's a really important point where you have interest rates that are impacting the asset value, and then you have QT that is sort of forcing liquidation of it to some extent.
I think that's an important distinction we don't talk enough about is QT, QE versus kind of interest rate policy. And I think one of the great challenges, the Fed is really trying to affect labor cyclically by using kind of primarily interest rates as the mechanism with which to sap liquidity. They haven't acted on the QT as many people have talked about, nearly as much as we kind of had expected at first. And I think that that's creating more uncertainty in a sense, because you're dealing with something with incredible lags and multivariate effects in the way of interest rate policy, as opposed to QT, QE, which really operate directly through the capital channel with much less of a lag to financial markets. I think it will be very interesting, given kind of some of this more economic lag and uncertainty and effects of interest rates, if we actually start to see real QT. We really haven't yet, or at least combine liquidity reduction in any meaningful way when you throw the Treasury General Account into play. I think that's something that is not being talked about enough. We really haven't seen the effects of QT on this market yet. In particular, as we go into the debt ceiling, which nobody's really talked about yet, there's, everybody's talking about the debt ceiling, the dollar and the potential issues related to the debt ceiling. I think there's an argument to be made here that not many people are making, that ironically, the biggest problem for this market might actually be, us resolving the debt ceiling crisis and the TGA having to be refilled afterwards. So just some interesting food for thought. But this QT channel, and general liquidity reduction from the capital side has not nearly been deployed enough. And if and when it actually does, which might be coming in the near future, you could really start to see some different type of market reactions.
Bob, see your hand there, man, and then I'm going to pick on Jem a little bit more.
Yeah, I think Jem is pointing out just a really important lever where, many of us are focused on the interest rate path, whereas in many ways, I think the Fed is leaving a lot on the table by not using the QT lever more extensively. And, it's important to recognize that how the QT lever, it involves the sale of bonds, but what happens with that sale of bonds, or I'm sorry, of the sale of the bonds, is that it forces others in the market to have to come up with the cash to buy the incremental bonds, which means it moves money out of typically riskier assets into bonds in order to buy them as the Fed sells them. And that process has, as Jim says, a very direct impact on asset prices. And if you think about what is the basic problem that the U.S. economy faces from the Fed's perspective today, nominal growth is too high. Why is nominal growth too high? Well, it's not a credit expansion. We don't have a typical credit-driven boom that many of us have seen over the course of the last couple of decades. We have an income boom. And so how do you start to, and that income boom is then leading to continued elevated nominal spending. And so how do you shift? What's the most direct way to shift that? It's not to try to slow credit creation. Credit creation is already slow. The banking system, credit creation, even before SVB, was already 0% over the first quarter of the year, yet nominal growth was 7.5%. So you've got to figure out a different path to start to slow aggregate demand in the economy, and asset prices are the way to do it. But so far, stocks are at 4,100. Like this, it's not that bad. They're down relatively minimally and up significantly from even a few years ago. And so if the Fed were to lean more on the QT lever, I actually think it would resolve a lot of these issues in the sense that it would start to bring risky asset prices down significantly, which would help curb demand and start to create that weakening of nominal spending. But it probably would lead to a rally in bonds as aggregate asset prices fell, which would help improve the liquidity and capital positions of many of these financial institutions. And that would probably lead to a better outcome than what they're pursuing right now. Now, why they won't, I mean, maybe Fed guy has some thoughts on why they won't improve why they won't lean more on the QT lever, but it doesn't make sense to me from a policy perspective.
I think their perspective is that QT is basically on autopilot, but I think we should have some perspective right now. So the maximum QT we're doing is $95 billion a month. The maximum last time around was $50 billion. So I think from their perspective, they're already turbocharging their QT. Maybe it's not enough, and obviously they're not able to hit their maximum target because of low prepayments and stuff like that. But I think there are also other things happening that could have an equivalent effect to turbo QT in the pipeline. The first thing is that there's going to be more Treasury issuance. So we had the Treasury's announcement today. It looks like they're going to have to revise up their coupon sizes soon. So one of the mechanisms of QT is increasing the amount of duration in the market. Looks like Treasury will have to do that simply to fund higher deficit spending. And another thing that channel that QT works is by draining liquidity in the banking system. And as Jim notes, once the debt ceiling passes, it looks like Treasury is going to have to issue $1 trillion worth of bills. Part of that is likely going to be funded out of the liquidity in the banking sector. So you will have money coming out of the banking sector and going into the Treasury general account as it goes from its current level of about $230 billion to its target of about $500 or $600 billion. So we have some tightening coming down the pipeline. Don't know if it'll be enough, but it's coming.
Perfect. Thank you both. Now we've got about 8 or so minutes until FOMC release here. But I do, real quick, before we get to that, want to take a look at how 2006, the last time we had numerous rate hikes and then a pause, played out to see if the panel sees any similarities here. The situation today isn't directly comparable because inflation is much higher today than it was then, and unemployment is lower. Moreover, that hiking cycle had been more gradual, giving officials more time to study the effects of their moves. If inflation was a nail, monetary policy was the hammer, according to Ben Bernanke. He said, we do not have to strike the nail, but we have to show that we are not putting down the hammer. We have to keep it in our hand. Jem, if you can, I'd love to get your thoughts on the volatility conditions now compared to what it was like the last hiking cycle in 2006. Jem, what are you looking for, given that back then there was only the Fed statement back then? No dot plots, no pressers, no options-driven market, and a small, larger effect of zero DTE and a presser. Jem?
Yeah, I mean, we are in a very different vol world. I've mentioned this before. Everybody's talking about the increase in zero DTE, but what very few people note with as much importance is the dramatic reduction in volume after zero DTE. We have a equal reduction in volume and hedging going on outside of zero DTE. Why is that happening? Quite frankly, it hasn't worked for several years, right? This is a typical cyclical effect to, people crowd into what's working and then they crowd out. And again, whether it's August 15 versus Feb 16, whether it's February 18 Volpocalypse versus Ocnov Dees 2018 slow decline, you have an ebb and flow, a vol reaction relative to market that is almost like a sine curve as people pile in and pile out. And we're in the kind of generally pile out part of that. People still want to hedge, but they're afraid to, that the vol is not going to help them in the next decline, much like we saw happen this last time around. So I think that's an important kind of dynamic. We have, however, in the context of that, seen significant also reductions in liquidity, with higher interest rates working through the markets. Broadly, there is per amount of volume, there is less liquidity. So that's also a broad risk. And then you take zero DTE options and the potential crowding into positions, long or short, there, and the circular powerful effects of gamma that can happen in the short term there. And it really is a combustible situation. And I think that's the important part to note. We are, this is not your grandfather's vol market. These are not, everything is much more dynamic, much more, crowded with less liquidity. That all said, in the very short term, we are seeing a significant increase in skew in equity vol relative to where it was just a month or two ago with the increase of this, banking crisis. We are also seeing lower vol, as many have seen, which has led to even higher skew, generally kind of inside baseball, but when implied volatility comes down, skew tends to increase. The downside options versus the upside tends to get more expensive. That has a reflexive, supportive effect. So not only has lower implied vol helped to pin markets a bit, because it's well supplied at cheaper levels, but that higher skew drives that kind of Vana and charm effect. So we're seeing some short-term supportive effects in the context of what is increasingly becoming a much more fragile system. So I do think reflexively going into this, assuming, the risk is more to the upside, if the Fed is apparently, dovish, there are structural effects that could push things higher. But ultimately, I think, as I've mentioned on other platforms, if we do get that here in the months to come, that could ultimately be the thing that unpins this market. Ultimately, it opens up kind of that real structural risk that we're seeing in terms of the fragility of markets.
Thank you, Jem. Now we've got about 3 minutes until release here. But before we get there, and sorry if we interrupt just to drop the rate hike, et cetera. But Bob, are things, as Jim said, more combustible? You have a great Twitter thread on the topic of the debt ceiling, outlining the importance of timing with the ongoing debt ceiling debate. Is this the powder keg, given Yellen said we have until June 1st, which is only in 10 legislative days from now in Congress?
Yeah, I mean, I think in many ways, the debt ceiling is sort of, it's certainly reflective of the difficulty of this cycle, particularly from a policymaking standpoint. That cycle, if anything, is a policy problem more than anything, right? It's a self-induced policy issue. I would just recognize that the speech, the June 1st number that that Yellen put out is more likely political speech than it is a matter of technical accuracy. I think most people who pencil out the numbers see the Treasury being able to get through the June 15th and June 30th dates, or if they trip it just right there, it would only be a few days of pause before more extraordinary measures could be applied at the end of June. And so odds are we're looking at a really acute moment coming later in July and August. And if anything, I think that creates some challenge, because kind of the Treasury is saying it's June 1st, and everyone's kind of looking at each other and saying, but not really. And so that creates the opportunity to sort of not move as swiftly as is necessary to resolve this quickly. So my guess is that the debt ceiling dynamic and its sort of orthogonal issues and impacts on asset markets and the economy are going to be sort of hanging over our head unresolved for a couple of months further, which is annoying to deal with, since that's more a matter of the political realm than it is the macroeconomic realm.
Thank you, Bob. 1 minute until release. Does anybody have any comments to Bob's response? Maybe Last Bear or Michael?
I could also say, as we're waiting our 1 minute, is that the odds that even if we get there and this isn't resolved, the U.S. is not going to default. The administration had a dry run back in 2011, or Treasury did, to prioritize payments. That's the most likely outcome, is a prioritization that maintains the continued payment of bonds and bills as is necessary, and probably a few other areas like the military through that prioritization. So, people saying, oh, the U.S. is going to immediately default. No, that's definitely not a base case or even a probable case. What is much more likely is we'll see a circumstance where prioritization happens, which would then create a big cut in fiscal spending, which would create a negative growth shock, and likely see a rally in U.S. Treasuries, counterintuitive rally in U.S. Treasuries, as well as rally in the dollar in response to that dynamic, a big negative growth shock. All right, we've got our release, right? I've talked to
that we
to the
do. Hey, you tied us right over, Bob. Thank you. So it looks like we got the expected 25 bips. A little, for lack of a better word, volatility in SPY as people start to digest. So I'm curious, as we kind of digest the release here, on some of the initial reactions to this 25 bips. I'm assuming this is basically what was expected by all of you. So it bears to question, do we feel, as we discussed earlier, that this will be the final hike before the pause?
I mean, they dropped the anticipates more policy firming to attain a sufficiently restrictive stance. So, on the margin, that is indicating a desire or a possibility of pausing.
Yeah, I think this is. I think it's a pause. That's my guess.
Call it the classic dovish hike here.
And actually, to your point there, Bob, in fact, in 2006, they did that same thing by officials deciding to signal a possible pause by dropping from their June policy statement the line that, quote, some further policy firming may yet be needed, and then paused. So does anybody have any other initial comments here before we continue down our previous line of thought?
Well, the one thing I'd say about this is, there's a challenge. The Fed is, I've described this a few months ago as a race between, inflation entrenchment and they're tightening sufficiently to bring, to slow the economy. The idea that they might, given the hikes that they've done, that they might, take a beat, RBA style, and take in some incremental data before making the next move, I think is more dovish than, if I was running the Fed, but also within the realm of reasonable. I think the main question, and maybe Joseph can give some perspective on, is whether or not they will feel constrained on a forward-looking basis by their choice to pause this month in terms of further raising interest rates in the event that the macroeconomic conditions warrant it.
Yeah, and we can definitely touch on that a bit more too. Michael, I see you unmuted there.
Yeah, I was just going to say that you cannot underestimate OPEC Plus's motives here. I have a strong suspicion that the April CPI is going to run hot as it captures that spike. And then the question is, when it starts capturing the subsequent downdraft, does OPEC Plus move again? As MBS likely wants to exert pressure on this administration. So
I like that Michael references OPEC. I think something that we should keep in mind is that there are a lot of geopolitical risks. Like what stood out to me was this morning, apparently Russia is reporting an assassination attempt on President Putin. Now, I don't know if that's actually true or not, but that's a pretext and that to do something potentially, and it's an escalation of geopolitical tensions. And war is really inflationary, so you have these big events happening across the world that will definitely spill over to what's happening here.
All right, so I want to actually, last Bear, go ahead.
Yeah, I was just going to add that obviously QT remains on schedule, no changes, which I think is everyone's expectation. But since I say we don't talk about it enough, just wanted to add that point as well.
Thank you, Last Bear. So I'm just going to take a quick little tangent. We've got 25 minutes before Powell's presser. But as a quick little tangent here, kind of going back to the Treasury buyback conversation, Joseph, traders are, they're getting more worried about the debt ceiling deadline, especially after Yellen gave that June 1st as the default date. Yields on 3-month T-bills are now the highest relative to 2-year rates since 1981. So, Joseph, are Yellen's concerns warranted here? And moreover, the TGA, or Treasury cash balance, has drained by about $78 billion on May 1st. And now there's only $238.46 billion until it's over and we face default. So, Joseph, is this related to Yellen's comments? And could you also maybe walk us through the buyback mechanisms?
Yeah, sure. So I'm in agreement with Bob. I am thinking that the U.S. is not going to default because the Fed has the tools and the mandate to prevent it. So I'm super complacent about the debt ceiling. So, right, if the Treasury were to default, there are some serious financial stability concerns. The Fed, part of its mandate is to prevent financial instability. And so what it will likely do, and which we found out through those subpoena documents from a report from the House Financial Services Committee, was that the Fed would prioritize payments, as Bob suggested. So every day the Treasury takes in cash receipts and it spends money on things like interest rate payments and missiles and Social Security and so forth. It has a lot of money coming in, more than enough to cover interest rate payments. So there's really no chance of a default. I think the point about Treasury buybacks, Nick, you mentioned, opens up the possibility of even more creative ways of handling the debt ceiling. One really interesting idea that Steve Moran mentioned to me would be Treasury buybacks as a way to actually extend the debt ceiling. Now, this is not something they're saying they're going to do, but it is a potential tool, and I'll explain how this could work. The Treasury debt ceiling, as we know, the Treasury can only issue so much debt. Afterwards, after it hits the ceiling, it can't issue any more. But that limit is on the par value of the debt and not the market value. And an interesting thing that's happened over the past year or so was that because of rapid rate rises, the market value of the debt is a lot lower than the par value for a lot of outstanding treasuries. So if you wanted to do a buyback program, you could issue stuff at par and then go and buy back stuff that's trading below par, and you would actually create a lot of room under the debt ceiling. Not saying that they're going to do this. They have no indication that they will. But again, this is just one of among, I'm sure, many other things that the administration could do if they really wanted to find more headroom under the debt ceiling. So there's just a lot of ways to get around this. I don't really worry about that. Totally agree with Bob's assessment that Yellen is probably putting political pressure on. One of the things that we've also learned from the House Financial Services report that I cited was that Powell doesn't like to talk about solutions to the debt ceiling from his end because he likes there to be political pressure to force some kind of congressional resolution. So I think this is definitely part of the game.
Thank you, Joseph. And I'll definitely move over to the panel here in a moment to get some other thoughts. But Joseph gave me a really good segue here to a question I had for Last Bear regarding these, creative ways to supersede the issue with the debt ceiling. So Last Bear, in your January issue, $1 bond and the platinum coin, you discuss a few methods of circumventing this debt ceiling issue. The $1 bond, which you said was conceptually attractive, practically infeasible, and the platinum coin, which you noted could grant the executive branch much more power than it should have. So Last Bear, could you walk us through what you feel to be the best solution?
Well, I think the best solution would be to raise the debt ceiling. And I think in between that and those two options that you picked, the option that Joseph just laid out about straight buybacks on this basically longer term debt that's trading at a discount to par would make more sense than either of those two more creative solutions. But in concept, the dollar bond is a similar sort of financial engineering type method to basically use a lower par value but give the same economic interest out through large interest payments. But I don't think it's practically very feasible, even though it's kind of a cool idea. And then the other one that I think gets more discussion is sort of the platinum coin, which is basically the idea that the Treasury can mint a platinum coin of any denomination. There isn't a strict cap in the legal rules on what that can be. So basically, could make a coin that would allow them to basically put funds directly into their own Treasury General account, thereby avoiding the need to increase debt securities outstanding or pass the public debt outstanding and be able to sort of fund themselves directly through this coinage minting, which I think some people have advocated for. I think would basically give the executive branch and the Treasury the power of base money creation, which is currently our system is set up so that that's the Fed's responsibility, and the Fed has the responsibility over price stability and general economic conditions, and therefore has the power of sort of base money creation to sort of target what they, how they want to achieve those goals. And I would be concerned about a situation in which the Treasury is therefore sort of unrestricted in their ability to sort of create new money, and therefore sort of taking those monetary powers out of the hands of the Fed. So that's that's my big conceptual problem with that solution that some people have argued for. Realistically, I don't think that either of those solutions are in any way likely. And I actually think that the buyback solution that Joseph mentioned, or just sort of some sort of new intervention, whether it be effectively the Fed allowing the Treasury to overdraft or prioritization of payments, all those things seem much more feasible than some of the more unique proposals.
Thank you, Lasper. Does anybody have anything to add to that, or to anything anyone else on the panel has said so far about the debt ceiling situation? So a question I would have here then, and this will go to the entire panel, feel free to chime in. One last final question to the panel as a whole here. Bill Ackman has said that, I reiterate the following: when MMF rates hit 5% on Thursday, who is not going to take their deposits out of their local bank? Do we think that the Fed screwed up here? And do we think Bill Ackman, a man famous for many reasons, is correct to say the Fed should have paused earlier?
I guess if I was a big asset manager, I would also be finding all sorts of reasons for the Fed to cut rates. But I think that actually misunderstands how the banking system or how the money fund system works as well. So some people are really rate sensitive, and they'll take money out of a bank and put it in a money fund for higher yields. But there are vast majorities of depositors who really don't care. And that's why across the cycle, you can see that even as the Fed funds rates goes to 4 or 5%, as it has in past cycles before GFC, you can see deposit rates still stayed really low. There's a lot of reasons to think about this. One is that most people don't even have that much money or don't even care. Another way to think about this is that banks provide services to people that are valued from beyond just deposits. So you can think about a bank providing payroll services to a corporation. Let's say a corporation has 50 people. Bank needs to make direct deposits every twice a month. Well, that's a service too that the bank is offering. So instead of perhaps paying higher interest rates to a corporation, the corporation receives these services. There's a lot of relationship ways to offer value beyond rates. And another note is that if you take money out of a bank and you put it in a money market fund, that doesn't actually take money out of the banking system. Then the money market fund has a deposit at the bank, and it could simply lend to someone else in the banking system. It could buy a treasury, and then the treasury spends that money back into the banking system. Or it could invest in a reverse repo facility, and in that case, money really does leave the banking system. But so far, that amount has been pretty range bound. So I think that line of thinking is not accurate.
Yeah, I think that's a good point that Joseph raised, one that I've mentioned a number of times, that it's not strictly a question of rates. It's really about how the reverse repo facility ties in with money market funds that actually removes cash liquidity out of the banking system. And I do think that is a significant issue that we still don't really have a lot of resolution as to some of the ideas around a big bill issuance to help try to drain those balances could work, could help sort of address that. But I think that's a big question, is how are they going to channel money out of the reverse repo facility back into sort of the banks? And it's not as simple as Joseph mentioned. It's not as simple as just looking at deposit rates versus money market rates.
Any other comments there to what Joseph and Lasper said before I move on to the next question? All right, so we have time here for one more panel-wide question, and feel free to expound. We've got about 14 minutes before Powell's presser, which we will be streaming audio here on the space and the video itself on the Unusual Whales Twitch channel. But for this question, given the 2006 language and pause, what do we think is in the future for the markets? Bob, want to start here on this question, and then we can move over to the panel as a whole before closing statements. It looks like Bob is having connection issues again, actually. So let's start with Jem here, and we'll move down the line.
I apologize. I'm going to have you repeat that because I actually was involved in a trade over here on can you mind reiterating?
Yeah, for sure. I've been fighting the urge this whole time as well, Jim. So, Jim, given the 2006 language and pause, what do we think is in the future for the markets?
Yeah, I mean, the reality is this. You have a slow moving removal of liquidity that is likely to kind of work its way through the boa constrictor or the python. In the meantime, positioning is still relatively short or unallocated. Vol dynamics are very much supportive still in the short term until we get past the debt ceiling issue. I think liquidity situations in terms of direct capital are still relatively strong. The QT isn't really acting, combined with the TGA on the markets. So the path of least resistance is sideways to up in the very short term. That said, the further we go, the more these this is like stretching a rubber band, both in terms of time and direction. If we get a bigger move the upside, that should eventually shake positioning from kind of some of that short positioning. It should unpin volatility and potentially cause a bigger issue. That combined with just simply the lag of monetary, of interest rates moving through the economy and the markets, paired with the eventual moving past debt ceiling and the TGA, effects that Joseph so well described, combined to a very interesting back half of the year. So it's really this in the short term kind of supportive circumstance, and vol compressing circumstance, while really shifting into the back half of the year, particularly if we go higher. The sooner we go higher, the quicker and more accelerated it can make these circumstances.
So kind of as a follow-up here to the panel before we get to closing thoughts going into the presser, based on what Jem just said, do we think that the markets may be a little optimistic right now? I know Jem has talked in the past and quite recently about how the effects of the Fed are kind of lagging, and we see this differential between, stocks are kind of up right now comparatively to how policies are taking effect. So my question to the panel, feel free anybody to chime in. Are the markets being overly optimistic, and do we have some turmoil on the horizon?
I'll chime in. I mean, I'll just say that, given if you asked me last year where the S&P would be given the knowledge that the Fed would embark on this aggressive of a ramp, and especially given starting valuations, I'm pretty shocked at where we are, and so I think I still think, for one, that there's a large amount of complacency priced into risk assets that are expecting the Fed to fold just like they've done the last several decades. If you think about, I go back to a space that I participated in, I don't know, a couple of months ago when Cameron Dawson posted a chart, which it's just been emblazoned in my brain, which basically shows essentially the core PCE since 1995. Or 1990, I should say, right? And it's basically been in this very, very narrow corridor of, call it 0 to 2% until now, where it's spiked to 5%. Now let's think about what's happened over that period of time. You've had the tequila crisis of '94. You've had the LTCM Russian default of 1998. You had the internet.com bust. You had the GFC. You had COVID. And every single time, the Fed was able to paper over the crisis with with massive stimulus and not have any repercussions. It's different this time. So I do think that we are in for a higher for longer phase that the markets are not ready for, or not pricing in, I should say.
Thank you, Last Bear. Michael, I see you unmuted, and then I want to kick over to Bob here before we move into the presser.
That was me.
Yeah, sorry. I think you had us reversed on that one, but I'm happy to take credit for Michael's smart thoughts.
I did get that backwards, didn't I?
No worries. I would just add in terms of the market dynamics, I'm actually pretty interested in corporate earnings these days. It's been basically flat for the past year, but hasn't yet decidedly sort of tipped over in one way or the other. Revenues are still growing pretty solidly. Obviously, some of that is driven by inflation, but the S&P is a nominal measurement. So you have strong revenue growth continuing, and so far, margins have come down a touch, but have basically kept overall earnings flat between those two dynamics. And it's unclear to me whether corporations are, whether earnings are set to start to fall, in which case I'd be much more concerned about valuation levels, or whether corporations, just given the years of being able to refinance at low rates, enjoy a ton of new revenue and margin expansion, I think are in pretty decent position, generally speaking. And so if they're able to if they aren't as affected by sort of the monetary conditions and are able to continue to sort of hold earnings at the levels they are, I think that provides support through the market as we sort of figure out what's to come on sort of the bigger picture macro horizon. So I just wanted to add to that point, but that's it for me.
Thank you, Last Bear. Sorry for that mix up again. I don't know what's going on. Maybe I was a little distracted watching that SPY chart chop around here. So what I want to do now, we've got about 7 minutes to the presser. I just kind of want to go down the line and get everybody's final thoughts on the markets, on the debt ceiling debate, anything you want to add here. And also, please plug anything you're working on, anything that our lovely audience here should check out to keep learning from you folks. I can't emphasize enough that everybody up here on this panel is invaluable when keeping an eye on these macro topics. So let's start here with Bob. Any final thoughts here on the markets, the debt ceiling debate, the Treasury, and anything you want to plug, Bob?
Sure thing. Sorry about the technical issues for a little bit, but the main thing I'm looking to the presser for, because the statement and the policy change are largely in line with our expectations. So the main thing I'm looking for is there nuance in the prioritization of the various issues that the Fed faces, whether that's matters of financial stability relative to inflation, relative to, I guess, the initial inklings of a moderation in growth. And so where are they tilting in one direction or another? That's what we're really looking to the presser for that bit of qualitative color. We may not get it, but that's what we'll be looking for. I think, thank you very much for having me. Really appreciate it. And love being on these spaces. For those of you who don't know me, definitely check me out on Twitter. I'm very active there. Or you can check out my day job, unlimitedfunds.com. I'm the PM of the HFNT ETF, which you should check out to see if it's appropriate for you. Thanks so much for having me.
Definitely go check that out, folks. And thanks as always for coming, Bob. Joseph, any final thoughts here and anything you got coming out or just came out that you want to plug, send some of these folks into some learning lands?
Well, first of all, thanks so much for having me. It's always a pleasure to join these spaces. So what I'm looking for today at the conference is whether or not Chair Powell will more forcefully iterate that he doesn't want to cut rates throughout the rest of the year. Again, when you have rate cuts priced in, that kind of makes their job more difficult, because then you have, let's say, mortgage rates staying low or coming lower, which potentially accelerates activity in that sector and other interest rate sensitive sectors. I agree with Bob's assessment that the economy is it's doing fine, and Jim's view that inflation is probably secular. So I think the market is seriously mispricing how the path of policy, and should the market eventually price in and become more in line with what the Fed is projecting, then we could see more volatility and downside in risk assets. So I actually started a YouTube channel. It's on YouTube. You can just Google, it's my name. And every week I post videos about my thoughts on the markets. And I also post a debrief about what I think about this FOMC meeting. So check it out. It's Joseph Wang is the channel. And thanks so much for inviting me again.
Thanks as always for coming, Joseph. These spaces would not be the same without you and your Fed outlook. Thank you. Jem, anything to add here before we get to that presser, and anything you want to plug?
First and foremost, this next couple of months heading in to the debt ceiling are particularly interesting given the tail risks tied to that, at least perceived tail risks tied to that, pairing that with the perceived tail risks of in the banking sector. I think it's on net done is it's really shaken some of the the Federal Reserve Board's members enough to really take a pause. I don't think, again, just based on month and a half, 2 months ago's, comments and where we were, we've moved significantly off of aggressive kind of Fed call selling. And so, this does represent a meaningful change in posture in the short term. I do believe it's going to end up being a mistake, that it is a short-term kind of reactionary move on policy that is not looking at the big picture. But I do think that will help exacerbate some of this short positioning and potentially squeeze it in the short term and eventually be, the thing that underpins that eventual vol move and more systemic problem as we move through into the back half of the year. So really some things to kind of watch and think about as we move through time here. Time is such an important aspect given the lag, given positioning, et cetera. So definitely keep all of that top of mind here in the short term. And then lastly, we have several hedge funds, all non-correlated. They really do focus on not market beta, just long-term diversified kind of return focus. We are launching a macro product, as well as recently purchased a wealth advisory service that focuses on this really non-correlated approach to investing. So anybody that's interested in that stuff, please reach out, kaivolatility.com/news.
Perfect. Thank you, Jem, and thank you as always for coming. Last Bear, any final thoughts here? We've got about 2 minutes before the presser.
No, just thanks for having me on this Spaces. I think they're always fantastic. The only point that I would add is just a watch for the Treasury issuance that comes after the debt ceiling. That's a lot of coin that needs to come out of either the banking system or potentially the reverse repo facility, and that those liquidity dynamics have been kind of stable recently between the combinations of Treasury funds and QT and whatnot, but they're about to get negative as soon as the debt ceiling is lifted. So something to keep an eye on. Otherwise, you can find me here on Twitter or on Substack. And thanks, guys, for having me.
Thanks as always for coming, Last Bear. Michael, any final thoughts here? About 35 seconds before the presser.
Thanks for letting me join on an ad hoc basis. As you guys probably know, I'm very interested in the intersection of macro versus geopolitics. So what I've written at length on my Substack, which is urbancowboy.com. And I'm probably going to write an update soon about how a higher for longer policy from the Fed could actually trigger a Chinese yuan devaluation. So thanks a lot again. Bye.
Thank you, Michael. And thanks, everybody, for being on our panel today. Everybody in the audience, thank you for coming and listening to the knowledge these folks have to share. If you're not following them, please do ASAP. You're going to learn nothing but good things from these folks. We are going to stream the presser audio here. It's starting right about now. And we'll also have the live video on the Unusual Whales Twitch, twitch.tv/Unusual Whales, if you want to watch the video with us, participate in the chat. Thanks again, everybody, for coming. Just give us a moment here while this presser starts up, and we'll get that audio running for you.